Welcome to Iron Financial, the only place where we forge stronger portfolios by hammering through market weakness. Today, we are putting DraftKings on the anvil. The company just dropped its Q4 earnings report, and look, on the surface, it looks like they've built an absolute fortress of a business. But then you look at the market reaction. It's as if Wall Street found a terminal crack right down the middle of the foundation. So today we are going to dissect the numbers, we're going to analyze the strategy, and we are going to determine once and for all if DraftKings is building an empire or if it's just a house of cards waiting for a gust of wind. Let's get into it.
Okay, let's just lay out the paradox right from the start. On one hand, you have DraftKings reporting absolutely monster, record-breaking Q4 numbers. I mean, revenue, profitability, every single metric looks like it's forged from solid steel. They crushed analyst expectations, which should be a clear signal of immense strength. But on the other hand, a 13% stock annihilation in after-hours trading. That's not a small pullback, my friend. That is a full-blown panic sell. So the fundamental question we have to answer today, the puzzle we have to solve is, what on earth does the market see that the glowing earnings report doesn't show? This is the core conflict, and we're going to get to the bottom of it.
Exactly. And look, before we get to the market's fear, which is very real, we first have to fully understand the strength. We need to analyze the core business structure that DraftKings has painstakingly built over the last few years. You simply cannot understand the cracks until you've thoroughly inspected the foundation. So let's drill down, let's get into the guts of these Q4 numbers and see just how solid this construction really is.
All right, let's start at the top of the income statement. The headline number, nearly $2 billion in revenue for a single quarter. Let's just let that sink in for a second. This isn't just about growth anymore. This is about sheer scale. They are operating at a level that very, very few competitors can even dream of matching. And here's the crucial part. This number wasn't just big, it was bigger than Wall Street expected. Now, the consensus was around $1.98 billion, so it's a small beat, I'll grant you that. But in this unforgiving market, any beat, even a small one, is a show of force. It tells you that their execution is incredibly sharp.
Now, if the $2 billion number is about scale, this next number is all about velocity, a 43% year-over-year expansion. This isn't just growth, this is lightning in a bottle acceleration. This is not some mature, sleepy utility company chugging along at 2% a year. This is a high-performance machine that is still finding new gears and accelerating hard. For a company of this size to be adding revenue at this kind of clip, it tells you two things. One, customer acquisition is still firing on all cylinders. And two, and this is maybe more important, customer engagement is rock solid. They are getting more revenue out of each and every user, which is the absolute holy grail for a platform business. This momentum is just formidable.
Okay. Growth is fantastic. We all love a good growth story. But for years, the narrative around DraftKings was growth at any cost. They were just a cash bonfire, burning through mountains of money to acquire users. Is this just more of the same story, just with bigger numbers? No, that's the old narrative. That story is dead. Look at this number, $343 million in adjusted EBITDA. This is the pivot point. This profitability metric is 4 times, a 400% increase over the same quarter last year. This isn't just a company growing its top line anymore. This is a company that is mastering its operations. They are flexing their operational leverage, proving that the business model isn't just scalable, but that it becomes wildly profitable as it scales. All that heavy lifting, all that spending from years past is finally starting to pay off with massive margin expansion.
And this right here, this is the capstone on the entire argument. This illustrates the turning point perfectly. For the first time in its entire history as a public company, DraftKings has reported positive full-year net income. This is a monumental milestone. This is a moment they officially graduate. They've transitioned from being a cash-burning, speculative growth story into a profitable, self-sustaining enterprise. This fundamentally changes the entire risk profile of the company. They are no longer just betting on some future state legalization. They are printing cash from their existing operations right here, right now.
So let's pop the hood and look at the engine room. Let's see how they're actually forging all this revenue. The core sportsbook business is an absolute monster. It jumped from $825 million to over $1.3 billion in a single year. That's a surge of nearly 64%. Folks, that's not just growth, that is a massive acceleration off an already enormous base. It's stunning. Meanwhile, you look over at iGaming, and it's providing stable, solid, and very profitable growth at over 17%. It's a fantastic business, but make no mistake, the sportsbook is the high-octane fuel in this engine. This isn't a balanced, slow-moving machine. It's a rocket, and the main thruster is firing hotter than it ever has before.
And this right here, this is the master key. This explains their newfound profitability. The net revenue margin, just think of this as their hold, or the profit margin they make on all the bets placed. It jumped from 5.5% all the way up to 8%. That is a massive 250 basis point expansion, a full 2.5 percentage points in a single year. So what does this actually mean in plain English? It means they are getting smarter. They have better modeling, they're running more efficient promotions, and they're seeing a huge surge in higher margin bets like parlays. They aren't just taking more bets, they are winning a bigger slice of every single bet placed on their platform. This is the kind of structural improvement that builds a true long-term fortress.
Okay, I get it. The fortress is built, the walls are thick, the numbers are undeniably strong. You've laid out an incredibly compelling case for the last 3 months of their performance. I'm sold. But that just brings us right back to the central problem, doesn't it? If the business is this perfectly engineered machine, why did investors scramble for the exits like the building was on fire? There has to be a crack in this armor somewhere, and for a 13% drop, it must be a big one. So let's stop with the victory lap and talk about why the market absolutely hammered this stock.
I mean, this is the question every single investor was screaming at their screen as they watched that stock price just waterfall after hours. You see a nearly $2 billion revenue print. You see 4 times EBITDA growth. You see the first ever full-year profit, and then you watch your portfolio get lit on fire? It just doesn't compute. It feels like the market knows some dark secret that you don't. And that feeling, that deep uncertainty, that is exactly what creates panic selling. And here is the answer to that mystery. The stock market is a forward-looking machine. It doesn't really care about what a company did last quarter. It prices stocks based on what it thinks the company is going to do next year and the year after that. So that entire powerful, beautiful Q4 report, it became ancient history the second the company released its guidance for fiscal year 2026. This is where the whole narrative shifts from celebration to deep concern. The rear-view mirror was gorgeous, but suddenly the view through the windshield looked incredibly foggy.
And this is the fog. This is the crack in the armor we were looking for. Just look at this chart. The company guided for 2026 revenue to be somewhere between $6.5 and $6.9 billion. But Wall Street, the analyst consensus, was expecting $7.32 billion. That is not a small miss. At the midpoint of their own range, they are guiding about $600 million below what everyone was expecting. In the world of high-growth tech stocks, that's not a crack, that is a chasm. This is precisely what spooked the market. It screams that a significant slowdown is coming, and it completely overshadowed every single positive data point from their brilliant Q4.
I agree, it's a chasm. But what if that chasm isn't a sign of weakness in the core structure? What if it's actually the foundation for an entirely new tower? The market sees that weak guidance and it screams, slow down. But management, the company, is telling a very different story. They're saying this is a strategic investment. They are deliberately tempering expectations for their core business because they are betting the house on an entirely new vertical. They're not patching cracks. They're laying a whole new blueprint for a much, much larger empire. And that new blueprint is called predictions. Okay, so let's get on the same page. Let's define our terms so this makes sense. When we say predictions, we are talking about regulated prediction markets. This is fundamentally different from a sportsbook. It's not sports betting 2.0. Instead of betting against the house, you are trading contracts on the outcome of future events, just like you trade a stock. Will this player score a touchdown? Yes or no? Who will win the next presidential election? What will a movie's opening weekend box office be? It's like a stock market for real-world events. And crucially, it's federally regulated by the CFTC, not by individual states like sports betting is. It's a whole new ballgame.
And you need to just absorb the sheer conviction coming from management on this. The CEO, Jason Robbins, is on record calling this the biggest, most exciting new growth opportunity since the Supreme Court decision that legalized sports betting in the first place. That is an unbelievably bold statement. He is signaling to the entire market that this isn't some side project or a cute little hobby. This is the next major pillar of the DraftKings empire. He is framing this as a massive land grab, and he's more than willing to sacrifice some near-term guidance to make sure they win it.
So why is he willing to take that short-term pain? This is why. $10 billion. That's what analysts estimate the total annual gross revenue opportunity for this entire market could be. To put that number into perspective for you, DraftKings' entire revenue for 2025 was around $6 billion. So they are looking at a brand new market that could potentially be larger than their entire existing business today. When you see a number like that, you start to understand why management is willing to absorb the pain of a guidance miss. They are not playing for next quarter. They're playing a much, much bigger game.
So, the bull case, the entire reason for this massive strategic pivot, is actually quite powerful when you break it down.
First, it expands their total addressable market way beyond just sports fans. Now they're talking to people interested in finance, politics, pop culture. It's a much bigger pond to fish in. Second, they can leverage their entire existing infrastructure, their tech, their powerful brand, their millions of existing users, to attack this new market with incredible efficiency. Third, they're already making smart moves, like the new partnership with Crypto.com to get immediate access and content. And fourth, and this is key, it creates entirely new revenue streams. They'll collect transaction fees like a stock exchange, and they can act as a market maker, profiting from the trading itself. They believe this is going to add hundreds of millions in new, incremental revenue, and that's just to get started.
Okay, that's the shiny blueprint from the architect. It looks fantastic on paper, doesn't it? A whole new tower reaching for the sky. But as any good contractor knows, the blueprint and the on-the-ground reality can be two very different things. And this brings us to the big debate, the core tension in this entire strategy. The bulls, they see purely incremental growth, a brand new customer spending brand new money on a brand new product. The bears, however, see a massive, massive risk of cannibalization. Are you really creating a new market here? Or are you just convincing your existing, highly profitable sportsbook customers to spend their money on a different and quite possibly lower margin product?
The bear case here is strong, and you'd be a fool to ignore it. First and foremost, you have that cannibalization risk we just talked about. What happens if you just move a dollar from your 8% margin sportsbook to a 2% margin prediction platform? That's a net loss for the company. Second, the heavy investment required to build this thing out is the entire reason 2026 guidance looks so weak. It's going to be a drag on profitability for the foreseeable future. Third, the regulatory environment is still foggy and uncertain. The CFTC is still figuring out the rules of the road here. Fourth, they aren't waltzing into an empty field. They are facing entrenched, specialized competitors like Kalshi and Polymarket who are already there. And finally, the biggest question of all, management keeps saying the impact on the core business has been de minimis, basically minimal. But can we really trust that claim? Or is that just what they have to say while they're making this huge, company-altering bet?
All right, we've inspected the foundation and found it to be solid steel and concrete. We've examined the crack in the wall and we understand that it was a deliberate choice tied to a massive new expansion plan. We've heard the bull case from the architect with his grand vision, and we've heard the bear case from the skeptical contractor on the ground. So now it is time for the verdict. We need to weigh all the evidence, put it on the scales, and forge a final actionable conclusion. Is this stock, after this massive drop, an opportunity for long-term investors, or is it a trap?
The bull case is crystal clear. The core sportsbook and iGaming business is a fortress. It's growing, it's accelerating, and its margins are expanding beautifully. Full stop. They're now taking the profits generated from that fortress to fund an all-out assault on a massive new $10 billion territory called predictions. And let's be fair, they have a proven playbook for this kind of expansion and all the infrastructure they need to execute it. But that bear case is just as clear and just as compelling. That weak 2026 guidance is a giant red flag that you simply cannot ignore. It creates a cloud of uncertainty that hangs over the stock. The predictions venture itself is absolutely fraught with risk, cannibalization of their most profitable business, regulatory unknowns, and very stiff competition. And at the end of the day, you can't argue with the tape. The market, for now, has voted with its feet, and it's signaling a profound lack of confidence in this new, expensive, and uncertain strategy.
So the verdict really comes down to your personal time horizon and your tolerance for risk. The Q4 numbers prove, beyond a shadow of a doubt, that the existing business is a robust, profitable machine. The guidance proves that they are willing to sacrifice near-term certainty and stock price for a shot at a much, much larger prize down the road. This is the classic textbook definition of short-term pain for potential long-term gain, which leaves us with the final question that you, as an investor, have to answer for yourself. Is what we're seeing a calculated deconstruction and rebuild, a strategic move to tear down a wall to build a whole new empire? Or is this a desperate, costly gamble on a new wing that could destabilize the entire structure and turn this impressive fortress into a house of cards? The next 12 months, without a doubt, will tell us who was right. Thank you for joining us on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.